Right now, Wall Street is preparing for the largest valuation magic trick in financial history. If you think we're looking at another version of the 1999 tech bubble and the SpaceX IPO was completely overvalued, what is happening right now behind closed doors with OpenAI will land directly in your ETFs and index funds later next year. On June 8th, 2026, OpenAI officially and secretly entered the IPO pipeline. They submitted their confidential S-1 filing to the SEC. The mainstream financial press immediately went into a frenzy, dangling headlines of an historic $1 trillion valuation. They want you to believe this is the ultimate growth story of our generation, but they are completely misreading the math. The raw, audited documents leaked days ago and reveal a terrifying market situation that standard financial outlets are completely ignoring. OpenAI isn't just spending money to scale, it is operating a business model that fundamentally loses roughly $1.22 for every dollar that it brings into the building. We are officially on a countdown. Goldman Sachs and Morgan Stanley are already organizing the institutional roadshow for the IPO. And the numbers that we're about to break down are not speculative. They're not projections. They're the audited, certified reality of OpenAI's balance sheet right now. And they prove that an impending public listing is less about funding the future of AI and more about finding a liquidity exit before the cash completely runs out. Let's look at the first pillar of the data, the top line growth. If you look at this on the charts, in 2024, OpenAI pulled in a $3.7 billion. In 2025, that figure skyrocketed to $13.07 billion. On paper, tripling your revenue in 12 months is an historic feat. But follow this downward expansion right here. To generate $13 billion in revenue, OpenAI generated a staggering $34 billion in total costs and expenses. Look at this massive $19.8 billion slice. That is just pure research and development driven entirely by training their AI models. And if you look at the other slice, that is the cost of revenue. Every single time a user runs a query, OpenAI incurs a fixed repeating cost that scales linearly. With every prompt, every image that you generate, they aren't achieving software scale. They are running an industrial manufacturing plant where they're taking a raw material that's compute and turning it into answers in ChatGPT. That brings us to the third chart, this circular concentration risk of funds. The leaked audited financials reveal that OpenAI paid Microsoft a mind-boggling $17.2 billion alone in 2025 for compute and R&D services. Meanwhile, Microsoft routes hundreds of millions of dollars back to OpenAI in commercial fees for OpenAI to show that they're making revenue. All while VC money flows from the outside, passes directly through OpenAI, and lands on Microsoft's Azure cloud balance sheet. This last piece of data really explains the trap. The top line revenue is being heavily recycled through this partner ecosystem to create the appearance of a hyper-growth AI company, which is actually operating at a loss for 2025 of over $20.9 billion. To understand why this is happening, you have to look at the physical reality of AI. Standard tech companies build a software once and then sell it over 1 billion times. OpenAI has to rebuild its infrastructure constantly. The company quietly communicated to investors that it expects to commit over $600 billion to AI infrastructure through to the year 2030. And that was a decrease from an original projection of over $1 trillion. The $34 billion that they spent last year, that wasn't a one-time peak. It was just an early installment on the CapEx payments that they're going to have to make. But here's the major corporate twist that standard media is going to misinterpret. They look at OpenAI's massive March 2026 funding round, where they raised an unprecedented $122 billion, and they assume the company has an infinite runway. They look at their current balance sheet and they see over $73 billion sitting in cash, and they think that OpenAI is bulletproof. But who is actually the one pulling the strings here? And why are they rushing towards the public markets now? If you look at the March 2026 cap table, Sam Altman is supposed to be the CEO of this trillion-dollar company, but he holds zero confirmed equity, and his position in the leaked document is listed as none or pending. At the exact same time, OpenAI is aggressively deploying cash to acquire corporate architecture for their AI models. Like on June 11th, they acquired a cloud infrastructure company called Ona, and they desperately want to pivot Codex into a secure enterprise software. They're dressing up their balance sheet for a corporate restructuring from a nonprofit to a traditional for-profit structure that is targeting enterprise revenue. So why go to the markets now? And that's pretty simple. The nonprofit model cannot absorb the losses that are hitting $38.5 billion. They aren't going public because they want to share this wealth with retail investors. They are going public because the private market can no longer absorb such a loss and continuing valuations. They need to go public to offload and exit. As an active participant in these markets, we can't afford to trade the hype. We must face reality. So here's our playbook for OpenAI's upcoming public S-1 filing. First, track the 15-day regulatory window. Under SEC rules, OpenAI must reveal its full, unredacted, audited financial statements exactly 15 days before their investor roadshow begins. Because institutional investors, if they expect GAAP losses to be around $25 to $26 billion for 2026, that is a nearly 80% higher than the numbers you're seeing quoted in the media. But if that GAAP loss crosses well above $25 billion for 2026, their implied multiples start to trickle outside the range that institutional investors can sustain. Second, monitor the head-to-head IPO race with Anthropic. Anthropic has submitted its own S-1 filing on June 1st, exactly 1 week before OpenAI did, and whichever pure play AI lab lists and IPOs first is going to absorb the majority of the institutional liquidity, leaving the second one to IPO highly exposed to a massive valuation drop. If OpenAI forces a premium listing to hit its trillion-dollar target, the immediate play isn't buying the equity. It's looking at the tech ETFs that will be forced to buy at the top due to passive index tracking. Data centers are now being built out all over North America, placing enormous demand on the power grid and creating a high-stakes bottleneck where major macro investors are already aggressively targeting it. Subscribe and like this video, ring the bell for our next video on the AI energy grid crisis.